But President Trump's working group, due to publish its first report any day, leans explicitly pro-tokenization and stablecoins. Crypto no longer splits neatly along party lines. Kraken, Coinbase, Robinhood, three very different animals, together worth well over $200 billion and suddenly playing in Washington's top agendas. Today we'll unpack why investors give them those juicy valuations, how each firm plans to stretch beyond plain vanilla trading, what the regulators are really up to, and where the entire crypto exchange business might land next. Welcome back to another edition of the Reporting Norms, the podcast that sits sometimes uncomfortably at the intersection of finance, regulation, and reality. I'm Norm Osumi, and over the next few minutes, we'll move through 4 layers of the crypto exchange business. First, we'll do a quick sanity check on the current valuations and the logic behind them. Then, the strategic moves Kraken, Coinbase, and Robinhood are making to keep those multiples aloft. Next, the fast-shifting regulatory mood. Yes, the SEC, the CFTC, and even the CFPB have parts to play. And finally, we'll take a look down range at what convergence with traditional banking and payments could mean for professionals and retail users alike. So let's begin by grounding ourselves in data. Coinbase, the only pure play crypto exchange with a major exchange listing, is hovering just shy of the $97 billion market cap. Robinhood, whose equity plus crypto model has broadened its appeal, trades around $93 billion, closing out recently at roughly $103 a share. Kraken, it's still private, is marketing a new $500 million fundraise that would lock in a $15 billion valuation, a sharp jump from the $11 billion price it carried in 2022. Those numbers matter because they frame everything else: M&A capacity, lobbying, budgets, recruiting power, but price alone never tells the full story. So let's peel back the layers. So why do these valuations make sense? Coinbase commands its premium for 2 big reasons. First, fee diversity. It still earns very fat spreads on retail spot trading, but roughly a third of the revenue now comes from staking USDC reserves and lately derivatives, helped by its pending $2.9 billion buyout of Deribit, the world's largest crypto options marketplace. Second, headline risk has receded. Remember the 2023 SEC lawsuit? Paul Atkins, crypto-friendlier SEC leader, withdrew the case outright back in February of 2025, signaling that enforcement would shift to rule writing rather than rule by litigation. Robinhood's valuation looks lofty at first blush, yet its story is less about crypto purity and more about optionality. Analysts pushed their price targets north of $100 after the company revealed European stock token trading and an L2 wallet that chops gas fees to just pennies. Add the February news that the SEC closed its crypto probe with no action, and the regulatory discount that once dog-housed Robinhood simply vanished. Kraken sits in a different bucket. Its $15 billion price tag or valuation reflects both upside, new lines like KRAK, a peer-to-peer super app, and a Wyoming SPDI charter that gives it quasi-bank status, and a small haircut for past tussles with the CFTC. That tussle related to a 2021 $1.25 million margin trading penalty. So if you close the books for a publicly traded company, Coinbase and Robinhood are the new comparables likely that your board and management are looking at and scanning for valuation benchmarking. Portfolio managers also look at these platforms because client assets often sit in their coffers uninsured or in omnibus wallets, creating a concentration of risk that auditors can't ignore. Retailers should note that a 9-figure valuation war chest makes lobbying possible. Those efforts can tilt the rules of the game long before the public comment period closes. Kraken's roadmap now reads like a fintech bank mashup. The freshly launched Krak app routes crypto and fiat across 110 countries and 300 different assets with debit cards and small loans on the horizon, a direct swipe at PayPal and Cash App. Coinbase, meanwhile, is stitching itself into mainstream finance. A brand new partnership with JP Morgan Chase lets Chase cardholders use credit lines on Coinbase and by next year convert ultimate rewards points straight into the USDC stablecoin. That is less an incremental feature and more a symbolic handshake between the $4 trillion US banking system and DeFi. Robinhood is betting on two fronts: fully regulated perpetual futures for European users and fractional stock tokens, which are blockchain wrappers that settle in seconds but track real equities. It also just closed a company called Trade PMR, a $41 billion registered investment advisor custodian, signaling that deep-pocket advisors, not just meme stock traders, are now in its sights. This acquisition of Trade PMR is quite significant because it means Robinhood is buying a platform that safekeeps assets and provides back office service specifically for independent advisory firms, also known as RIAs, to help those advisors serve their end clients. As I discussed in my previous podcast on the SEC and various investment acts, RIAs provide investment advice for compensation and are generally registered with the SEC under the Investment Advisors Act of 1940. So on Capitol Hill, crypto no longer splits neatly along party lines, but President Trump's working group, due to publish its first report any day, leans explicitly pro-tokenization and stablecoins. At the SEC, Chairman Paul Atkins has replaced what he calls regulation by enforcement with an open rulemaking docket. The agency's own press office confirms that a digital asset disclosure framework is in draft, expected before year end. Across town in Washington at the CFTC, leadership hasn't forgotten its remit. Margin products still require registration, and Kraken's past fine remains the case study every compliance officer cites Commodity Futures Trading Commission. Finally, the CFPB wants consumer protection parity. A January 2025 proposal would apply the Electronic Funds Transfer Act, think chargebacks and error resolution windows, to wallets that move stablecoins or even Bitcoin for exchanges that rely on instant finality as a selling point. That's a potential mechanism to squeeze margins for those companies. So putting these threads together, a picture emerges. In the next 3 years, we're likely to see fully FDIC-insured accounts that toggle between dollars and stablecoins with a single tap. Fee compression on spot trades as derivatives and payments subsidize revenue, and a clear two-tier regulatory market. Tier A for U.S. licensed, big for audited venues. Tier B for offshore leverage shops. Real-world asset tokenization, the fancy term for putting treasury bills and maybe even mortgages on blockchain rails, is already creeping into Robinhood's pipeline. That shift matters because it drags crypto from a speculative playground to the plumbing of everyday finance. Crypto exchanges have sprinted from curiosities to systemic platforms before many risk managers even finished updating their internal policy manuals. The valuations we discussed today underscore investor faith, but also embed sky-high expectations for innovation and compliance. Auditors will likely need to provide proof of reserves attestations. If you're a corporate treasurer, rethink counterparty risk. And if you're a retail investor, remember that regulation always lags innovation, sometimes just long enough for new kinds of mistakes. And then finally, for CFOs, CAOs, and controllers, first, make sure you've early adopted FASB ASU 2023-08. All eligible crypto now goes at fair value, so verify price feeds and hierarchy levels before you lock the ledger. Secondly, SAB 122 supersedes SAB 121. It no longer forces a blanket safeguarding liability. Instead, apply ASC 450 and apply a contingent liability only if loss is probable and estimable. Update that risk memo and any roll forwards as well. Thirdly, classify income correctly. Staking or lending fees fall under ASC 606, crypto derivatives under ASC 815, because the SEC is already flagging adjusted EBITDA numbers. Fourthly, tie tax lots to Form 8949 and record staking rewards as ordinary income the moment you have control. The IRS's latest guidance is crystal clear. Finally, run a subsequent event sweep right to the filing. As many of you know, it's an after close hack or a 10% price swing can trigger an ASC 855 disclosure. Be mindful of these 5 points and you'll likely keep the audit adjustments and potentially the comment letters at bay. Again, I'm Norm Osumi, and this has been the Reporting Norms. If you learned something today, hit that subscribe button on YouTube, Spotify, or Apple Podcast, and feel free to share this episode to any colleague that still calls crypto magic internet money. Until next time, stay transparent.